everyone, and thanks for tuning into the Financial Investor channel. My name is Brent, and today is Wednesday. So as of course you know, it is 5 stocks with ex-dividends next week. This is sort of a regular thing with me, and being a dividend investor myself, I do like to look for stocks that could pay me a nice income, that are also on a very nice path for the future and are resistant proof to recession. So we're going to be covering whether they are overvalued, undervalued. We're going to take a look at their 1 year, 5 year growth, take a look at their past. Are they recession proof? Have they overcome any of the losses that they took during the 2000-2008 recessions? Take a look at their payout ratio. Are they paying out very little, where they can continue to increase their dividend through time for say the next 10, 20, 30 years out? Or do they pay a very high payout ratio where they may be cutting back or stopping the increase of dividend payout in the future? So let's go ahead and get into that. So if you are brand new to my channel, I do make stock market, financial, and investment videos weekly, so do consider subscribing for future financial videos. So the very first stock we're going to cover is Raytheon, and its ticker symbol is RTN. And right off the bat, you can see that this stock here is highly overvalued at its current time. It's not at a good value price. I'm not going to look at its financial sheet and tell you that it's overvalued financially. Just by the chart definition, you can see that it averages around $160 on an average for the last year, and its yield averages around 1.9%. Right now it's sitting at $188, so it has had growth, steady and consistent growth. Look at that huge spike after the election. That's November. So we'll take a look at the 1 year and 5 year graph on Google here, but you can see after the election it had nearly a 10 to 12% climb, 135 to 145. That's a good 10% growth right there. And then that's another huge spike right here ever since May into our current times. There's been a lot of friction between the United States and North Korea. So as you know, Raytheon is a U.S. defense contractor with core manufacturing concentration in weapons and military and commercial electronics. So it's a military company. They're going to design and build weapons for the United States for defense, right? So let's go ahead and jump over to Google, and we'll type in the ticker symbol RTN stock and take a look at its information here. So it has a dividend yield of 1.69. Its current price to earnings is 25.99. So I like to look for stocks during this time around 25 or below. So this one would be one that I would want to take a look at its balance sheet. How much money does it have on hand? How much debt does it have? And how has it been doing from quarter to quarter and year to year? So let's go ahead and take a look at its 1 year. We can see that here, after the election on November 4th was prior to the election, and November 8th was the election. We'll say November 10th. You can see that there was an increase of nearly 11%, and then ever since the election, it has had a very nice steady increase, increasing more than 27.49% this year alone. Now its 5 year has had humongous growth, 239% as of August 5th, 2012. So very good company long term. Max, now the dot-com bubble, that was a pretty big hit here. You can see that it lost nearly 76% of its value, and it recovered it very quickly actually. You can see that, let's see here. Actually, it did not recover. I'm sorry, I went from here to here. Let's go across. So it did take, before it reached back to the point here, it took nearly 14 years before the stock that fell during the the dot-com bubble recouped 11 years later. Now, the dot-com bubble is not going to happen every single time. I don't believe it's going to happen again. You can see that the 2008 crash here is more likely to happen, and this company does recover well. It doesn't recover as well as some of the other consumer stocks that I've seen, but given time, say 4 to 5 years, the stock will recover in price. And being a dividend and income investor, I'm looking at a consistent payout in dividend. So this company currently pays, has a yield of 1.69. Let's jump over to dividend.com and take a look at its payout ratio and dividend history. So it has a payout ratio of 42.1, so it's well below my 60% ratio that I like to look for. It pays out $3.19 per share for each year per share, and that's 1.69% yield. That's basically taking the current price and dividing it into the it's actually backwards. You're dividing the current payout, which is $3.19, divided by the current price, which is 188.31, and then times it by 100, and that gives you the current yield of 1.69%. And if you were, say, to wait a little bit for a drawback, which I don't believe is going to come, the yield would be slightly higher, but we already looked at it here on the chart. It's very overvalued at this time. Dividend growth, it's had dividend growth for the past 12 years, so it has paid out through the 2008 recession. So we'll have to look at when it began paying out dividends. Its dividend is next week, of course, on October 11th, and that is Wednesday. So if you'd like to get paid dividend for the stock, you will need to buy it on Tuesday and hold until Wednesday, when you can sell off the stock and claim the dividend pay. You would then get paid on November 9th. And it's had an annual growth of 9.7, so I like to look for growth between 5 to 8, so this definitely blows, it's a very nice growth pattern, and it has annual growth for the last 3 years of around 10.1%. So very nice growth in dividend payouts. You can see that it increased their dividend payout from 73 cents to 80 cents, so that's that growth here. Now it looks like they did pay dividends back in the past prior to the 2K crash here, but then they had a cut back on their dividend payout, and then continued after. Well, they cut it prior, so that you could see that during this time here they cut out their dividend. They were expecting something to happen, and it did happen here. And then afterwards, in 2001, they continued it back on its course, and then have continued to pay out that dividend, increasing it in 2005, and then increasing in 2008, 2009 during that other recession. They continued to increase it since then. So this could be seen as possibly recession-proof, but if another instance such as the 2K happens, you can see that they may stop paying dividends altogether. This is a qualified, it is a qualified dividend, meaning that it is qualified as a dividend, meaning that you'll only get taxed 15% on your dividend income instead of your normal tax bracket. So the next stock we're going to be talking about is ABBV, which is ABBV Inc. This is it's a pharmaceutical company that discovers, develops, and markets both biopharmaceuticals and other drugs. So I currently hold this stock, and I have actually very much enjoyed it. I bought it back here in, I believe, May. I've had it quite a while. I had Abbott and then AbbVie. These have both been great pharmaceutical companies. You can see that for a while they were very undervalued, and then as of September it had a huge spike. I'm actually up over, I believe, 25% in this stock. So at this current time, it is not undervalued, it is overvalued at this current time. It used to have a yield of nearly or over 4%. Now I believe I bought it around 3.8, 3.7, so I am very much enjoying this stock. So it is currently overvalued at this time. Let's take a look at its history here. So ABBV, let's take a look at its 1 year and 5 year. 1 year, you can see it has had nice growth of over 42% in the past year. In the last months, it has had an increase of over 28%. So very good growth. You can see that its price to earnings ratio is well below 25, my rule of 25 and below. Has a dividend yield currently sitting at 2.85. And if you don't know, let's actually take a look at its 5-year growth of 171.82%. And if we take a look at its 2013 AbbVie broke off from Abbott. During my research into AbbVie, whether it was a buy or not a buy, you can see here it originated in 2013 as a spin-off of Abbott Laboratories. And between Abbott and AbbVie, I decided to go with AbbVie, due to the higher dividend, the better financial and balance sheet, and just the kind of development that they were working on at the time. They came out with a leukemia drug, just a couple. It was FDA approved, so they've had a nice list of accomplishments as them. So that is it. I can't tell you whether they are going to. I believe they are going to be a good resistant to recessions here. So ticker symbol is ABBV. Okay, so this has dividend growth for the past 44 years because, as you know, it's a spin-off of Abbott. Abbott has had dividend growth for the past 44 years. That has a very low payout ratio, below 60%. That's my happy spot. 60% and below, so it can increase and continue to increase dividend throughout the years for the next 10, 15, 30 years out. It currently pays out $2.56 per share. Its ex-dividend date is on October 12th, so as long as you are holding the stock on October 11th, which is next Wednesday, so you need to own it on Tuesday, then you can get paid this dividend on the 15th of November. Its annual growth from year to year has been 12.9. It averages around 12.5 average for the past 3 years. And it has had consecutive year increases for the past 44 years. We can see here that the last time it was paying out 57 cents per share. It's paying out 64 cents per share. In the next quarter, it's probably going to be increasing it to around 70 cents per share. Let's see here. Around 70 cents per share is going to be the next dividend. And of course, my dividend yield will increase due to the increased payout in comparison to their current price, or my buy-in price. So of course they are a qualified dividend, meaning that you only get taxed 15% on your dividend income instead of your normal tax bracket. Our third stock is Oracle, ORCL. It's a multinational computer technology corporation, and this stock is actually on the news because it's jumping on the blockchain. It's going to try and jump on blockchain, Bitcoin and all that new technology is coming out. They're trying to jump into the whole game, and they believe it's going to help drive their stock to the mainstream and get brand new investors to buy into it. So in the past, you can see earlier this year it had a yield of nearly 1.5%. It's currently sitting around 1.4. It's been kind of waving up and down. You can see it's on an upwards trajectory, so I believe the support is moving on an upwards motion. So in the future you could see the stock potentially move to say 55 to 60 in the future, in the foreseeable future. So this one is currently overvalued. All of these stocks so far have been overvalued. Raytheon's been overvalued, AbbVie's been overvalued, Oracle's been overvalued. It's very hard to find a stock in this current time that is not currently overvalued. But let's go ahead and take a look at its 1 year and 5 year, so ORCL. And take a look at its 1 year. So it's had very nice growth for the past 1 year, up 25%, and in 5 years, up 55%. So it averages around 11% per year with the dividend payout of 1.5, so around a 12.5% increase per year. And of course that dividend, if you're reinvesting it back into the company, it compounds, so you get a higher increase in your shares and you get paid out more. So very nice. Let's see here. Let's take a look at their past. Now this company had a huge loss back in the .com when it burst, but since then each recession that it's gone through, it has easily overcame it. You can see that this 2008 recession took place in the housing market and financial sector. While it may have affected ABBV and Raytheon, it didn't phase Oracle. and their software and technology just continue to sell, and it barely was a hiccup here. So since the 2010, they have increased nearly 170% since 2009, 2010. So very good growth, very good company for the long term. If you can get it at a decent price, you can see that there's times where let's go ahead, I'll show you real quick. Their ticker symbol is ORCL. So each year they've been increasing dividends for the past 5 years. Very low payout ratio, 28. That's very nice. That means they can continue to have dividend growth continuously, even through the recessions. I believe that they would continue to pay out that dividend pay. They pay out 76 cents per share. And what would happen here is they may increase their payout to say 85, 86, which would cause their current yield to kind of jump and provide you with a current value buy, where you're buying into a company at a decent price, where it's going to actually give you a dividend yield of around say 2%. But okay, so let's go ahead and cover its ex-dividend. So its ex-dividend is on October 10th, which is next Tuesday. So you have the opportunity to buy this on Monday and hold into Tuesday, and then you would be paid out this month on October 25th. It has had dividend growth of 5.3%, annualized growth of 35.7%. So some irregular. Oh, this is probably the last 3 years. Let's see here. So they increased 5 years ago is when they began paying dividends, increasing. They probably had a spike 1 year where they weren't paying anything. Whoops. And then they began paying out. So let's go ahead and check it out down here. You can see that there was a spike here. So here's that 35% average spike. So they normally have an average of around 5%, but they had a huge spike right here, and then they kind of dropped it back down. So this one has not paid through a recession. So what company was this? Oracle. So this company does well through recessions, but they don't have any history of paying through a recession. They have paid out after a recession. So if you're just looking for a nice growth and possible dividend stock for the future, Oracle may be a good buy. That's for your decision, right? So they do have qualified dividends. So again, with the tax, and let's move on to our fourth stock. We're running at 17 minutes and 30 seconds here, so I'm going to try and hurry it up just a minute. I know I don't want to take a whole bunch of your time. And Graco, GGG. So Graco is an American manufacturer of fluid handling systems and products. It is primarily in three sectors: industrial, contractor, and lubrication. So very good company, even in times of recession, because what does everybody need during times of recessions? They need the industrial, they need the contractors, they need lubrication for their vehicles and tractors, and just all sorts of manufacturing equipment. So very good company. Ever since May, it looks like it's been on a nice upward trajectory. It was sitting at $95. It's sitting at $24. So what's that? 20-30% increase there. So very nice growth in the past 1 year. They are currently overvalued at this time. That's unfortunate. It looked like actually pretty decent. Let's take a look at their 1 year and 5 year. They have a very low dividend yield of 1.16, a very high price to earnings ratio. So taking a look at this would not be one I would invest in. It has a very high price to earnings. So they are profitable, but at the same time, it's not. Actually, I don't know if they are profitable. Could be. Oh, they of course they're profitable. Otherwise, they wouldn't have a price or a PE ratio. So let's go ahead take a look at their 1 year. 1 year growth of 69%, 5 year growth of 151%, and let's take a look at their 2000. So 2000, it was nothing to them. You know, technology took a hit, but this sector, this stock just kept on going. 2008, the financial and housing. I could see how an American manufacturer of such products could be hurt a little bit by that financial and housing. And then since then, you know, it only took a small hit. It lost 63% of its share, but within just a couple of years, look at this. Very good recovery right here. It recovered in about, let's see, 3 years. It recovered, and then since then has had growth of over 195%. So Graco does look like a great company. It is very recession proof. You could see that history normally tends to repeat itself, so if you were to invest in this company, it's very high price to earnings again, but it does look like if you got into this company at a good bargain, it could provide you with good growth for the future. It has paid out through recession, so the 2008-2009 recession, it paid out through that recession. It has a very little payout ratio of 31.9, pays out $1.44 per share. Its ex-dividend date is on the 13th, so that is next Friday. So you must own it on Thursday or before in order to be eligible for the dividend pay on November 1st. It has annual growth averaging 10% and averaging 9.7 for the past 3 years. That's very good growth for the past 3 years. Looks like they may have missed a quarterly. Let's see here. They pay out every quarter, so 12. I have to look down here. This is a better graph here. So they pay out 2, 5, 8, and 11. 2, 5, 8. They missed out on August's pay. So they didn't pay out in August. So something may have happened. I'm not sure. I would have to look into the headlines as to what, but they might be doing a special pay in the future. You can see that there was a special pay here of $1.50 per share, which is very high for what the current price per share was at that time. But as you can see here, they've had regular stock splits in the past, and then have continued to pay out their dividends. So 12 years ago? 12 years ago of dividend growth. So we're in 2017, so that would be 2006 was the 2006 was their last time that they did not increase or something here. They did increase their dividend, and that was mainly due to a stock split. So they stocked their they pulled back. It was 3 for 2. So they gave you 3 for every 2. That's an interesting one. That's not bad. You know, they give you 3 for every 2, so basically it's 1.5 per share. And then they continued the dividend increase, so it's not bad. What would be a good buying price for the stock? I wonder. Looks like it's gone up. As of September, it's gone up 73% just in the last year. So let's see here. It would be hard to find a good buy-in point in the stock, but that's interesting. Let's go ahead without spending too much more time. I do think that this stock is a good stock so far. It's probably one of the better ones. It is just overvalued at this time. Or not one of the better ones. Of course, I bought ABBV. You know, I think ABBV is a great stock, but without looking into Graco a bit more, that would be my secondary pick. Let's go ahead and take a look at my last stock here for you guys. It's AFG, American Financial Group. Now, AFG is an American financial holding company based in Cincinnati, Ohio, whose primary business is insurance and investment. So, again, another overvalued stock. That is unfortunate. I was hoping to grab one of the stocks here that may have been undervalued. So this has had very nice growth as of the elections here. Again, look at this. Back in November, sitting at around $75, $72 per share. So, you know, again, financial company, business, insurance, investments. What's been going on, and why is everybody here on this channel? They're watching stock market financial videos and investing in their future. So there's been a lot of new investors in the market. I've been investing since 2000. Well, I've been investing for a very long time, but I primarily did bonds and CDs. I didn't do a lot of stocks up until 2015. So stock market wise, I'm sort of new, but bond investing, a majority of my my own financials is based off bonds, and they paying out dividends and such. So let's see here. AFG. So they are a overvalued stock. I'll take a look at their 1 year and 5 year. It is AFG. And take a look at their 1 year. 1 year, you can see that they've had very nice growth as of October 2016. Here's the elections again on November 7th, and then after the election, it shot up, 6% after the election, and then has gone up over, let's see, in the year, what was it in the year? Over 40%. It's a very good growth for the year. Past 5 years, that's very nice steady growth, 172%. You can see that as of the elections, it is a little bit overvalued. I would see that this one's probably sitting at, it should be around 85 or so would be the good valuation point for the stock, just based on the trajectory here. If you were to draw a line from here this way, it would sit right around 85 or so. But it's actually price to earnings is 11.83, so it's a very profitable company. It has a valuation of only 11.8, so very good. That would be one to look at their financial and balance sheet. Look what kind of debt they have, what kind of risk they're taking. A lot of insurance and investment companies, they take quite a bit of risk, but this could be one to look into. Let's take a look at their dividend history. So AFG, they have a very low payout ratio of 20.8%. They have had dividend growth for the past 11 years. So that's actually very unusual. When it comes to financial, insurance, investment companies, besides AFLAC, I believe AFLAC, I think that's AFLAC, what was it, AFLAC, I'm just going to go quickly. That's another insurance company, but I believe, it's had dividend growth for 34 years. So it's sort of an investment, insurance, financial sort of company, American Financial Group. I know a lot of the other stocks, such as JP Morgan, they stopped paying dividends during the 2008-2009 recession. So this stock actually here, AFG, continued to pay through the recession. They have had a very low payout ratio of 20.8. They don't have a very high dividend yield, but you're just looking for something consistent. So let's go ahead and continue. October 12th is their ex-dividend date, so that is next Thursday. So we need to buy it on Wednesday or prior to Wednesday in order to be eligible for that dividend pay on October 25th. They've had dividend growth of 11.9 or average growth of 12.7 for the past 3 years. That's very good annualized growth, and they have continued to increase their growth. So say if you held the stock for 7 years, you put $1,000 into it, and they pay you, what was it, 1,000, I can't do math right now, $13.30 per year for your $1,000 investment into the company. After 7 years, the rule of 72 still applies to dividend. So 72 by 11 in 7 years or less, your initial investment, say you were paying $13 in 7 years or less, you would actually be paid $26 based on your investment, and just continue and continue. So if you put in more, say 3,000, you'd be paid a little bit more, $39 per year, and then it would be $86 in 7 years or less if you didn't pay out, if you didn't increase your equity in that specific stock. They've had, wow, that's very nice too. They've had, along with having very nice dividend payout and dividend history and consecutive years of dividend, they've also have these very frequent special pays. So they pay out $1 per share. So even though they may have a very low dividend yield, if you average in all of these times that they've paid out $1 per share, you're probably sitting at around a 3%, 3.5% dividend yield. Now, these special pays are mainly targeting their current shareholders. They're basically, if you own the stock at that time, you're going to be rewarded for owning their stock, for being a shareholder for the long term, and they're basically rewarding you because if you're not in the stock at the time, if you're a day trader or a swing trader, you're not going to be eligible for these special pays because you don't know when they're going to happen. But if you're a long-term investor and you buy and hold the stock that you know pays their stockholders these special pays, then you're more than likely going to be hit with a couple of them. I know Costco is another one that pays out these special pays every 2 years. Their dividend yield may not be high, but when you average in these special payouts, they average around a 3% payout from their special pay. So you can see here that they pay out very regularly, say every year or more, slightly every year or more, but if you're buying for the long term, that could be a good buy. And that is it for this video. So we had Raytheon, RTN, ABBV, ABBV, ORCL, ORCL, Graco Inc., GGG, and American Financial Group, AFG. All 5 were overvalued. If I had to pick my number 1, I would go definitely with ABBV. Second would be Graco. Third would be AFG. Fourth would be ORCL or Raytheon. You know, that 4th position. I think all of these stocks are great. They are just overvalued, but they have very good growth for the future. Majority of them are recession proof. You could just look at their payout ratio and their dividend history, their past record, and you can kind of make a good choice for yourself. So that is it for this video. Hopefully you have found it entertaining. I want to thank you for watching up until this point. If you did like the video, hit the like button, and please remember to subscribe. If you have any questions or want to say hello, please leave a comment below and I will always reply. Thanks for tuning in, and I will see you next time. Bye.